Hey soldiers, let's dive into the question, could your bank be next? Could what happened to SVB, Silicon Valley Bank, happen to your bank? Well, maybe is actually the answer to the question. Go ahead and hit subscribe, hit the thumbs up, guys. Help with the algorithm. We need to spread this information. Now, we talk a lot on this channel about your relationship with a bank. We all know, if you are a soldier of finance, you already know that a bank is not a place to keep your money with the expectation to make money, all right? Savings rates are anemic, okay? Wells Fargo has like a 0.25 rate on most of its deposit savings accounts. Meanwhile, inflation, the lowest measure of inflation, is 6.5%. The highest is somewhere in the neighborhood of 14%. So the area between 0.25 that you're getting from a Wells Fargo on a savings account, and let's just say 6.5, the lowest measure of inflation, that area between those two metrics is you drowning, your money losing money. So look, banks, hey, if you want to make money with a bank, go in and, do some due diligence on an income producing property and maybe take out a loan, or take out a loan to build or grow a business, okay? That's how you make money with a bank. Or, hell, the bank's business model is just genius, all right? Because while they're giving you 0.25%, go check out a Wells Fargo credit card and the interest on that, all right? They're going to charge, 16% at least in this day and age? So that spread equals billions of dollars for banks. So the business model for a well-run bank makes a lot of money. Savings account, guys, look, that savings account you have at the bank, well, look, for me, and I am cautious, I'm not giving you advice, but I'm going to tell you what I do. I don't keep any more than 3 months worth of expenses in a bank savings account. I want it, handy if I need it, so that I can defray or eliminate interest charges from a credit card if I have an emergency or an opportunity. But keep in mind, my savings account at that bank, that's an asset for me and a liability for the bank. It goes on their balance sheet as a liability. And the reason for that is pretty easy to understand, because it's a demand account. I can come in at any time I want and demand all of the money or some of the money, and that will reduce the bank's ability to lend, okay, and make money. When they lend me money, then that money becomes my liability and the loan becomes, of course, their asset. But if it's just sitting in there in savings or some interest-bearing checking account, that's my asset and their liability. So, there has been some talk about, they were making these exotic investments and that's what took them down. And that is partially true. But the real crux of the issue with SVB, and this could be the case with other banks, is the interest rate risk. Silicon Valley Bank, SVB, they were in a unique position. They had a lot more deposits than they could lend out. So it put a lot of that money, or most of the rest of it that they weren't lending out, they purchased bonds or bond-like instruments. This is the thing that ended up sinking Bear Stearns and Lehman Brothers. Mortgage-backed securities, okay, was one of the things they invested in. So then Jerome Powell and the Fed started to raise interest rates. And in an environment where interest rates go up, bond prices go down. Now, okay, and the reason for that is because when the Fed hikes these interest rates, what's known as the coupon on an already issued bond, it remains the same. But in order to make that yield more competitive to new buyers, the price has to go down. Okay, think about it. If you've got new bonds being issued that are going to have a better return, of course, the bonds that are out there with the lower return, they're going to have to sweeten the pot somehow so that price goes down. Now, if you're buying bonds, and bonds are loans, basically. You can think of a bond as a loan. It's one of the reasons why in a bankruptcy proceeding, the bondholders are up front in terms of getting made whole or redress because they've extended a loan, whereas someone who's gone out and purchased shares of stock, they're owners. So as an owner, you take on a different type of risk. And the bankruptcy courts realize that and recognize that. So in order to increase the yields, you've got to buy bonds with longer dated maturities. Now, the reason you do that is because think about it, a bond that's got a longer maturity date, there's more risk there for the company or the individual that is owed the money. A lot can happen in a longer period of time. Whereas if it's a short duration loan or bond, then the yield is not going to be as attractive or as high as the longer dated maturity. So Silicon Valley Bank was out there. They were trying to increase their yields by purchasing longer dated bonds. But the problem is these are more sensitive to the fluctuations in the interest rates. So when interest rates go up, the market value of SVB's fixed income securities went down because there were more attractive bonds being issued at the higher interest rate than what SVB had. So when SVB signaled that they needed to raise more money, kind of to mitigate what was going on with this variance in the bonds that they were purchasing, well, that was a signal. And a run on the bank started. Now, the bank is getting a lot of criticism right now because they could have mitigated the situation. There were ways that they could have actually hedged their risk against these rising interest rates. But Jay Ursapa, who is or was the head of financial risk management and model risk for Silicon Valley Bank, looks like she was otherwise engaged and had a lot of other projects going on that didn't necessarily involve financial risk to the bank. We actually got a report coming up on that tomorrow. So if you're not subscribed, go ahead and do so. Hit the bell icon so you'll be notified when that drops. So what's the average person to do about this? Well, again, I personally am not going to have more than 3 months worth of expenses in a bank. All right. This is ludicrous from the standpoint of inflation eating up the money. Even if the bank is in the healthiest condition possible and has no problems, you're still getting your money eroded. But some of that cost is worth it just to have the money on hand and available immediately, especially when you consider the fact that if you're putting bills on credit cards, you need to pay that off before the 30-day cycle is complete. Otherwise, you're going to be up in the neighborhood of 16% or maybe more, depending on what kind of interest rate you have with your credit card. So you're talking about paying inflated prices for whatever you purchase with the card, and then on top of that, paying that interest. So that's going to be just astronomical. In that case, it makes sense to me to be able to, mitigate that with some money in the bank. The other thing you need to do, and this goes hand in hand, is just keep the amount of money you have in the bank below the FDIC insured limit. If you're not going to have your money insured above a certain amount, why have above a certain amount in that account, in that bank? Because, look, I don't know who I'm talking to out there. You guys could be much, much wealthier than me. It's highly possible, highly probable in many cases. Fine. All right. But we are learning that just because you have a lot of money doesn't mean you are endowed with a lot of financial knowledge. Okay. We just talked about the young lady that was the head of financial risk, Jay Ursapa. I would imagine that this young lady probably graduated from a great school with great grades and, maybe even top of her class. But that didn't help. SVB now did it. All right. So, look, that's my suggestion on this, guys. Look, we're following this story. We've done some reporting on what's going on over at SVB. Check it out and just hang on for the ride. I mean, developments are occurring and it's a fast moving story. It's changing all the time, but we will continue to report on it. Guys, I'll talk to you soon.